Hi everybody, Andreas here. In today's podcast, we will continue from where we left off last time, where we introduced the concept of inflation. And today, we will go over how central banks tackle the problem of inflation and how it impacts exchange rates of currencies. Most central banks have a mandate which is to keep inflation low and steady. As a rule of thumb, most central banks tend to hold a target inflation rate of around 2% year over year. We must note, however, that some central banks not only have a mandate to watch over inflation, but also to promote full employment. For example, the Fed, the United States Central Bank, has a dual mandate. Same goes for the Reserve Bank of New Zealand, as well as the ECB, the European Central Bank. The primary tool deployed by central banks to contain inflationary pressures is the increase or decrease of interest rates accordingly, or in other words, hiking or cutting rates. Manipulating interest rates is used as a mechanism of readjusting the inflation rate within the economy in an attempt to bring inflation back to the acceptable target level whenever there is deviation. It is widely accepted that 2% inflation is healthy and contributes to the steady, gradual growth of an economy. In order to understand how central banks act, let's consider two scenarios. One where the inflation moves to the upside, in other words, raises above the 2% target, and when inflation moves to the downside, in other words, falls below the 2% target. In the scenario where inflation falls below the 2% target, central banks tend to lower interest rates in order to boost inflation. Conversely, in the other scenario where inflation raises above the 2% target range, central banks tend to raise rates in order to bring inflation back down. Now, let's have a look at the mechanics behind it. In the first scenario where we had inflation lower than the 2% target, we noted that central banks tend to lower interest rates to stimulate borrowing. Why is that? Because lower rates make loans more attractive for consumers since the monthly installments fall and are easier to make. The interest rate which is paid upon the loan is lower as well, and this leads to increased borrowing within the economy. Because lower rates make loans more attractive for consumers, since the monthly installments fall and are easier to make, the interest rate which is paid upon the loan is also lower, and this leads to increased borrowing within the economy. As a consequence, higher borrowing costs boosts economic activity since borrowers either spend or invest their funds, and since economic activity increases, that in turn causes the demand to increase. Hence, an overall increase in the demand for goods and services will cause the price to rise. Thus, finally, inflation rate is lifted towards the 2% desired target. In the second scenario, when inflation is above the 2% target, central banks actually raise interest rates to curb high inflation, and practically higher rates would render loans as less attractive or unattractive, which in turn would lead to a lower borrowing, to a slowdown in economic activity that will lead to lower demand for goods and services, and finally towards decreasing prices. Now, interest rates as such usually tend to also affect exchange rates. When central banks are raising interest rates, it usually causes the affected currency to strengthen. While, if the central bank reduces its rates, it usually leads to a weakening of the currency. Another way to think about these reactions is in the context of how much you will receive in return of saving your money at the bank. Let's consider an example. If the Australian Central Bank suddenly raises interest rates, it becomes a more attractive place for international investors to save their money, capitalizing on the interest rate differentials. But in order to save your money in Australia, that means that you have to convert your local currency into Australian dollars in order to be able to make the deposit. That would lead to more demand for the Aussie, and thus the currency strengthens. The opposite is also true. Suppose that Australia cuts rates, or in other words, reduces its interest rates. The Australian dollar becomes less attractive because an investor would be able to park his money in a different country's bank with higher rates, and that will lead to a conversion from Australian dollars to another currency, or if you prefer, there will be less demand for the Australian dollar, and thus the currency weakens. Now, how strong or weak a currency is has implications also for inflation. Central banks tend to pay attention to the exchange rate as well, with a classic example being the Bank of Japan or the People's Bank of China. A weaker currency means that an economy's exports become much more competitive abroad as they are cheaper for foreign consumers. But in contrast, it also means though that imports into the same country become more expensive. In actuality, that will mean that the weak currency provides you with higher in-house prices within the country's economy, in other words, high inflation. So, if you are a central bank trying to raise inflation, say from 1% to 2%, a weaker currency can help you achieve just that. On the other hand, a stronger currency brings the price of imports down, which may hold overall inflation in the economy down as well. Now, in some extreme cases, central banks tend to step into the market in order to balance the supply and demand for its currency. In case the currency is weaker than desired, the central bank will buy its own currency, or in other words, sell its foreign reserves. An example is the Central Bank of Turkey, where there was a moment when the Turkish lira was weakening considerably, and the bank, in order to stop that weakening of the lira, intervened in the market. Practically, the central bank entered the market and bought Turkish liras by exchanging it for US dollars and euros, depleting considerably the FX reserves. On the other side of the spectrum, if a country's currency is stronger than desired, central banks print money, also known as quantitative easing, and use it to buy foreign currencies. Classic examples of such interventions are the People's Bank of China and the Swiss National Bank. This brings us to the end of today's podcast, where we went over how central banks' monetary policy changes can also affect exchange rates of currencies. In our next podcast, we will visit the concept of expectation theory. Thanks for listening. Stay tuned.